What is up, everybody? Welcome to the 15th lecture of Contemporary Math. Today we're going to be talking about section 8.1 and 8.2, so percentages, sales taxes, discounts, and income taxes. And to start off with, let's start by talking about what percentages are, just reviewing them, right? Well, a percentage by definition is just the parts per hundred of a thing. So what does that mean? Well, we can think of it like trying to measure how much of this entire circle this particular wedge accounts for. We could think of the circle being broken up into 100 slices, and then saying, all right, of all those slices, how many of them belongs to this purple wedge? Well, if there's 100 slices, then the number of those slices, of those tiny slices that will fit inside of this larger purple slice, that would be the percentage of this wedge to the entire circle. So having said that, how do we calculate percentages? Well, if what we're starting with is a decimal, we just multiply it by 100, which is effectively the same thing as saying, let's take the decimal place and move it to the right twice. If, however, we start with a fraction, we can just turn that fraction back into a decimal and then do the top. So, let's look at two different examples. Start off with, we've got the example of the decimal 0.3333. We want to turn that into a percentage. So, we're going to multiply 0.3333, multiply it by 100. This is going to be equal to 33.3. But of course, it's not enough to just multiply it by 100. We now have to tack on the percentage sign at the end. So we can say the decimal 0.3333 as a percent is 33.33%. Pretty straightforward. Now, in the second example, we're given a fraction. We want to turn that into a percentage. Okay, well, we can use log division, calculate what that is as a decimal, and then we can turn that decimal into a percentage. So let's do that really quick. We've got 42 divided by 50. So 0.8 is going to give us 400, 200, 400. So after mumbling all of that to myself, what we just did is we used log division to find out what 42 divided by 50 is. It comes out to be 0.84. All right, cool. We know what that decimal is now. 0.84. So we just apply this again. From here, 0.84 times 100 is equal to 84 as a percent So, as a percent, we get that 42 over 50 is equal to 84%. Dope. Pretty straightforward. So the obvious question now is, what if we want to go in the opposite direction? Well, let's take our example 33.33 and move it in the opposite direction. First, we would drop the percentage sign, and then we would divide by 100. So, using one division, 33.33 comes out to be 0.333. And we just know that from one division, right? Like, we can finish the rest of that. All right, so how might we use it now? Happy you asked. We're gonna use it with sales taxes and with discounts. Dope. All right, so sales tax. The way sales tax works is we're taking the base cost and multiplying it by whatever the tax is. We're saying, all right, that's the amount of the sales tax. Now we're going to add that back to the original cost. But it's not enough just to say, we're going to multiply the cost, the base cost, by the tax. No, of course not. This is a math class. It can't be that easy, right? Now, the sales tax is given to us as a percentage. So we have to take that percentage, turn it into a decimal, and then multiply the base cost. Then once we do that, once we multiply the base cost by the sales tax as a decimal, then we have the amount of sales tax, and then we can add that back into the base cost to find out what the total cost of that item is. So having said that, let's look at an example. We've got a 55-inch TV that we can buy at either a Walmart or a PX. For those who don't know, a PX is what's called a post exchange. It's on an Army bases. They don't have sales tax. So, we've got this 55-inch TV, and it's $300 at Walmart. Or we can get it at the PX for $310. The catch is, though, the Walmart has a sales tax of 6.5%, and the PX, like I said, it has no sales tax. So which one's cheaper to buy the TV at? And that means we're going to have to go all the way through and find the total cost, right? Okay, let's do that. To start off with, it is probably going to be easiest if we figure out what the sales tax is and the prices are at Walmart and then at the PX and organize them out that way. So let's do that. Well, at Walmart, it was $300. That is the base cost. And the sales tax at Walmart was 6.5%. Meanwhile, at the PX, the base cost was $310. And the sales tax is 0%. All right, so let's calculate what the price is, what the total cost is at Walmart and at the PX. Start off with, because the sales tax at the PX is 0%, we know that the amount of sales tax is going to be 0, right? Because 0% turned into a decimal is still 0. 0 times 310 is still 0. 0 plus 310 is still 310. Cool. So the total cost is going to be 310. All right. That leaves Walmart to handle, to work with. So let's break up our space a little bit. We want to know what the amount of sales tax is for the TV at Walmart. So that's going to be 300 times our percentage written as a decimal is 0.065. Multiplying them together is going to come out to be 19.5. So, we now know that the amount of sales tax is going to be $19.50 at Walmart. So what's left is to add $19.50 back to 300. To find that the total cost of the TV at Walmart is $319.50. At the PX, it's $310. So it's $9.50 more expensive once you include sales tax at Walmart. That's really all there is to sales tax. Having said that, let's go back really quickly to this idea of total cost. Here I wrote it out a little bit differently. I wrote out a little bit longer formula than what's in the book. What I want to point out here is, notice if we take the amount of sales tax, and we rewrite it as our tax times our base cost. In this form, we can factor out our C, our cost, and we get that the total cost is our percentage written as a decimal plus 1 times the cost. So what that means is instead of doing all of this, we could have made it a little bit easier on ourselves and multiplied 300 by 1.065. Cool, so let's move on to discounts. To calculate sales discount, what we want to do is we first want to calculate the exact dollar amount that we're taking off of our price, right? Then we want to subtract that discount from the original cost. Pretty straightforward. Having said that, let's say we've got this computer for $400 and it's being discounted by 20%. To find out how much it's going to cost before sales tax, we would say that the discount is equal to $400, 20% as a decimal is 0.2. That's something we always have to do, right? We always have to revert the percentage back to a decimal if we're going to multiply or do anything with it. So 400 times 0.2 is going to come out to be $80. The total cost is now going to be 400 minus the $80. Come out to be $320 before sales tax. So, having said all of this, just like with sales tax, I want to point out there was another way we could have gone about finding what the total cost is going to be. If we look at the original equation for the total cost, we see that it's the cost minus the discount, right? Well, we can rewrite the discount as the percentage, the discount times the cost, right? Percent discount. If that's the case, then our total cost after the discount is going to be C, the cost, minus the percent discount times the cost, which is going to be equal to, after we factor out the cost, it's going to be equal to 1 minus the percent discount times the cost. Now again, I want to point out, or I want to remind you, whenever we calculate things like sales discount, sales tax, etc., we always want to revert our percentage back to a decimal form. Having said that, let's move on. Before we move on to income taxes, I really quickly want to touch on percent change. To calculate percent change, all we're looking at is the amount change divided by the original amount, and then taking this fraction and turning it into a percent, just like we did at the beginning of this the lecture. Having said that, there's an example that I personally like in the book, example 9 at the very end of 8.1, that I would like y'all to take a look at. It's a pretty decent example of where percent change might show up in the real world. Having said that, let's move on. Before we get into income taxes, we need to go over some vocab first. Start off with gross income. Gross income is really defined as just that, it's income. Be it in the form of, say, maybe you won a lottery, or your job pays you X amount, you sold something at a farmer's market, whatever it is, it's income. Gross income is income, to include things you may have won like cars or houses. Adjusted income, adjusted gross income, is your gross income minus things that can't be taxed. So, student loan interest, that can't be taxed. Certain savings accounts or retirement plans can't be taxed. So you would remove those quantities, whatever part of your income you put into those quantities, you would remove that from your gross income, and they're called adjustments. Cool. Taxable income now is your adjusted gross income minus exemptions and deductions. So, to save us some time, I'm not going to go over what exemptions are or what deductions are, not into too much detail. The book does a good job at explaining those. Instead, I'm going to let you know that deductions, there are two forms. You have to choose one or the other. You can either use a standard deduction or an itemized deduction, and you want to choose the largest. The reason why you want to choose the largest is because it's going to make whatever your taxable income is less. So choose the bigger between your standard deduction or your itemized deduction. So let's play with this some. As an example of calculating the taxable income for a person, let's look at example 2 on page 501. What we've got is a woman who makes $62,000 in a year. Her adjustments are $4,000. Her exemptions, which I'll explain what that is in a minute, is $3,800. She has a choice of either using an itemized deduction or a standard deduction. If she uses an itemized deduction, there are 3 things that she could be pulling from, 3 items, for a total of $12,100, or again, she could use the standard deduction of $5,950. So to calculate the taxable income, the first thing we need to calculate is the adjusted gross income. And we know that the adjusted gross income is the gross income minus the adjustments. So, 62,000 minus 4,000 is going to come out to be $58,000. So our adjusted gross income is $58,000. And we got that by subtracting the gross income, for the adjustments from the gross income. Now to find the taxable income, we have to take the adjusted gross income and subtract the sum of our exemptions and our deductions. All right, so I said I would explain in just a second what exemptions are. Exemptions are a value that's provided to us by the federal government that we can pull from our taxes, from our adjusted gross income, for every person dependent on that gross income. So, let's say you have two dependents. There's 3 people now, right? You and your 2 dependents. For each one of them, you can pull this fixed quantity from your adjusted gross income. And we call that an exemption. In this woman's case, she has only herself to worry about, so her exemptions are just $3,800. All right, so gross income minus adjustments is adjusted gross income, $58,000. Now we're going to subtract our deductions and our exemptions added together. So we have $58,000 minus $3,800 plus, well, which deduction should we use? That becomes a new question, right? Or the next question, rather. Well, I said before that we should always pick the larger of the 2. Between itemized or standard deduction, we should pick the larger of those 2 deductions. In this particular case, the largest deduction would be to pull the itemized deduction, right? Because that has a total of $12,100. And all we did was add up the 3 items that she had listed for her deduction, added them all together and said, all right, the itemized deduction comes out to be $12,100, which is of course larger than the standard deduction. So we're going to use the itemized deduction. All right, so we're adding $12,100 to $3,800. Then we're going to subtract that quantity from the $58,000. And all this comes out to be $42,100. This is her taxable income. And we found it by starting with their gross income, subtracting the adjustments. That gave us the adjusted gross income. Then we took the adjusted gross income and subtracted from it the sum of exemptions and deductions, choosing either the itemized deduction or the standard deduction. And that gave us the taxable income. All right, so we have the taxable income. How do we calculate her taxes now? We'll get to that in just a second. Before we can move on and actually calculate what the final income tax is for an individual, there's 2 more things we need to go over. Tax computation and a tax credit. Tax computation is how we actually get to one of those final forms of, it's one of the last things we calculate, I should say. What it really is how we use tax rates and filing statuses combined with your tax brackets to calculate what you owe. Typically, most Americans, most people, think that, as an example, if your taxable income is $25,000, then you're going to have to pay $3,750. And they come to that conclusion by saying, all right, well, I'm making $25,000 as taxable income. Looking at this, I'm in that $8,701 to $35,350 tax bracket. So I must be taxed 15%. Not quite. It's not quite how it actually works. What we do when calculating the tax computation, we look at what you make. And we say, all right, this much is in this category, this much is in this bracket, so forth, so on, until we get to the final bracket that your final income belongs to. All right, so what does this look like? Well, in practice, what this looks like is to say, all right, I make $25,000 in taxable income. Cool. This is after deductions, exemptions, and adjustment, right? This is my taxable income. Based on that, $8,700 of it is in that first bracket. The remainder of what I make is in this second bracket. So that first bracket, that first $8,700 gets taxed at 10%. But that second bracket gets taxed at 15%. And because of that, your final tax computation is going to be $3,315. Finally, if you want to know what the income tax would be, then you have to subtract any tax credit you may have. And that'll be the final amount. That's what your income taxes are. All right, so what's a tax credit? What is it, right? Well, by definition, it's quite literally an entitlement. It's a credit that the government gives you to say, hey, of your tax computation, this is the quantity that you can take off, dollar for dollar. So if you were to have a $500 tax credit, instead of paying $3,315, you would pay $500 less. Pretty straightforward. So $2,815. That's all a tax credit is. Having said that, let's look at that last example and calculate what the final income tax would be for that particular individual. Returning now to example 2 on page 501, what we had was a woman who made a gross income of $62,000. She had an adjusted gross income of $58,000. For exemptions, she had $3,800. She used an itemized deduction, remember, that was $12,100, so she chose the itemized deduction instead of the standard deduction. And we used that to calculate that her taxable income was $42,100. All right, using that, her taxable income solidly puts her inside of this third bracket, right? So that means we have to find out how much is taxed at 10%, how much is taxed at 15%, and how much is taxed at 25%, and add them all together to find our tax computation. To do that, we're going to take 10%, multiply it by $8,700, then we're going to take and tax the amount that sits inside of here at 15%. So that's going to be $35,350 minus $8,700. And we're going to take the remaining amount and tax it at 25%. So that remaining amount is going to be $42,100 minus this $35,350. And we're going to find that all this together is going to be $8,700 plus $3,997.50. Let me write it like this. $8,700, $3,997.50, and $1,687.50. Add all of this together. That's going to give us $6,555. So, what we've done, we went through and we said, all right, there is $8,700 that she made that gets taxed at 10%. Then, pulling that out, we have to worry about the next tax bracket. There is all the money she made from $8,700 to $35,350. That's taxed at 15%. And then from $35,350 up to the $42,100 in taxable income that she made, that has to be taxed at 25%. When we do the calculations, at 10%, we have that comes out to be $870. At 15%, that bracket came out to be $3,997.50. At 25%, that amount here came out to be $1,687.50. And all of it added together comes out to be $6,555. Okay, this is her tax computation. We're not done yet though. So, tax computation, $6,555. We're not done because there's still one last thing we need to worry about. Her tax credit. We have to subtract her tax credit out of this tax computation to find out what her income tax is. So, income tax is equal to, in this case, $6,555 minus the $500 for her tax credit, which comes out to be $6,055. So this brings me to another common mistake that I want to talk about. I previously said, in the few minutes ago, that there was a common mistake that's made when talking about taxes. Oftentimes we talk about our taxable income times whatever the final bracket percentage is. And I said that's wrong. There's another misconception that it's just your gross income being taxed at whatever that tax bracket is, which is also wrong. And to show how wrong that is, if that was the assumption, If we were to assume that she should be taxed at 25% for making $62,000, that would be way, way larger than the $6,055. Notice she's only taxed about 10% in the end. That's about what her income tax comes out to be. So, one last thing to go over after this, FICA taxes. Before I explain how FICA taxes are calculated, really quickly want to explain what FICA taxes are. FICA taxes are the taxes that pay into Social Security or Medicare. The way they're calculated is really the same way that tax computation was calculated. We say for the first $110,000, you tax at 5.65%, and for every dollar you make more than that, they're taxed at 1.45%, assuming you're not self-employed or an employer. So, the way it breaks out is we have three different groups. You're an employee, you're the employer, or you're self-employed. And the employer matches what the employee pays out. So if we wanted to calculate for you as an employee what your FICA taxes are going to be, assuming you make $150,000 in a year, we would take the first $110,000 and tax it at 5.65%. And we would take the remaining amount and tax it at 1.45%. So what does that look like? Well, it would look something like this. 5.65% times 110,000 and 1.45% times 110, my mistake, 150 minus 110,000 So this is going to come out to be 6,215. Then this quantity is going to come out to be 580. And we're going to add them together and find that our total FICA tax is 6,795. So your personal FICA tax would cost you $6,795 as an employee making $150,000 a year. And the way we found that was by taking the first $110,000 and calculating 5.65% of that, and then taking the remaining amount, so the remaining $40,000, and taxing that at 1.45%, and then adding them together. And that is all I've got for y'all on this chapter, on this section. If you have any questions, by all means, please feel free to shoot me an email. Have a good one.